In the dynamic world of auditing, how can we navigate complexities with precision and insight? Enter the risk-based audit approach, a strategic compass illuminating the path to effective risk assessment. By centering our audit processes around understanding and mitigating risks, we pave the way for thorough, targeted evaluations that yield valuable insights. Embracing this approach empowers auditors to proactively address potential pitfalls, ensuring robust and reliable audits. Let's embark on a journey where risk assessment isn't just a step but the very foundation of our audit endeavors. Welcome to our course overview, where we delve into the essential facets of risk and audit. Today, we embark on a journey exploring the intricacies of business risks, from operational hurdles to strategic challenges. Uncover the nuances of fraud risks, decoding red flags within the fraud triangle. Then, we venture into the realm of audit planning, crafting strategic approaches tailored to identified risks. And finally, we embrace the concept of professional skepticism, nurturing a probing mindset throughout the audit process. Let's unlock the secrets of risk management and audit excellence together. In the world of business, risks lurk at every turn, threatening to derail even the most well-laid plans. These risks, whether looming large or hidden in the shadows, pose a formidable challenge to a company's goals and aspirations. As auditors, our task is clear: to unearth and evaluate these risks, for they hold the key to uncovering any potential discrepancies in financial records. When risks run high, errors and deceit can easily slip through the cracks. To ensure the integrity of financial statements, we must delve deep into the heart of these risks, deciphering their implications with precision and foresight. Only then can we safeguard the truth and trust that underpin every audit. What types of risks can businesses face? Operational risks arise from day-to-day failures in processes, technology, or human resources. Financial risks involve market changes, currency fluctuations, and credit issues impacting stability. Strategic risks stem from poor decisions, competition, or market shifts affecting long-term success. Compliance risks result from failing to adhere to laws or industry standards, leading to penalties or reputational harm. Each risk category presents unique challenges, requiring careful management to safeguard business operations and longevity. Ever wondered about the crucial difference between business risk and audit risk? Business risk involves the daily threats faced by a company, while audit risk is the danger auditors face of issuing an incorrect financial opinion due to undetected misstatements. Interestingly, higher business risks often translate to higher audit risks, especially in financially strained companies. As auditors, our task is to navigate these risks diligently to ensure accurate financial reporting. Fraud, a cunning act of deception for personal gain or harm. In our audit, focus lies fraudulent financial reporting and asset misappropriation. While management guards against fraud, auditors delve into assessing risks and crafting detection strategies. Think about it: how can we uncover the hidden truth behind the numbers? Stay vigilant, for the numbers may not always tell the whole story. Be the detective amidst the numbers, seeking out the truth within the shadows. Ever wondered what factors can lead someone to commit fraud? Enter the fraud triangle. Picture this: rationalization, opportunity, and pressure/incentive converge, creating the perfect storm for fraudulent behavior. Financial stress, lax controls, or mental justifications can tip the scales towards dishonesty. The allure of easy money or the need to meet unrealistic targets can cloud judgment. Weak internal controls provide the opportunity to deceive and cover tracks. And rationalization? It's the dangerous mindset that normalizes deceit. In essence, the fraud triangle illuminates the complex interplay of human psychology and situational factors that breed fraud risk. Remember, where these elements intersect, vigilance is key. Ever vigilant, auditors must heed the ominous signs of fraud risk lurking within organizations. Watch for telltale indicators like management's aggressive stance on financial reporting, a track record of flouting regulations, and undue pressure to hit targets. Beware the dominance of unchecked leadership and red flags in industry trends, be it a declining sector rife with failures or rapid, suspicious growth. Keep a keen eye on internal control weaknesses, such as lax monitoring, frequent executive turnover, outdated accounting systems, and a lack of duty segregation. Stay sharp, for the landscape is treacherous. Ever wondered how financial statements can be manipulated to deceive users? There are two primary types of fraud to watch out for. Firstly, there's fraudulent financial reporting, where intentional misstatements are made to meet targets or secure financing. This can involve recognizing revenue too soon or manipulating expenses. On the other hand, misappropriation of assets involves theft, like skimming cash or inflating expense reports. While financial statement fraud aims for big numbers, asset misappropriation often involves smaller amounts but higher frequency. It's crucial to be vigilant against these deceptive practices in the financial world. Remember, a company's financial health may not always be what it seems. In Chapter 3, we dive into the risk-based audit approach. Rather than spreading resources thin, this method sharpens our focus on high-risk areas. By aligning procedures with identified risks, audits become more efficient and effective. Picture this: a targeted strategy that hones in on what truly matters. By concentrating efforts where they count the most, we ensure a thorough and precise audit. This approach is like having a spotlight in a dark room, illuminating the path to accuracy and reliability. In the dynamic landscape of auditing, the risk-based audit process is a cornerstone strategy for ensuring effectiveness. Assessing risks across business, fraud, and control realms sets the stage. Then, a meticulous dance of performing procedures through testing and evidence gathering unfolds. Understanding the client on profound levels, their industry, operations, and controls is non-negotiable. Next comes the pivotal moment of evaluation and reporting, culminating in the formation of a well-informed opinion to be effectively communicated. Finally, the design response phase kicks in, where procedures are meticulously planned based on varying risk levels. This methodical journey is all about precision, insight, and adaptability in the face of complex challenges. One thing is clear: in auditing, embracing a risk-based audit process is not just a strategy, it's a mindset. Ever wondered how auditors navigate the complex terrain of audit risk? The audit risk model offers a roadmap, breaking it down into three key components. Inherent risk, the susceptibility to errors before considering controls. Control risk, the potential for internal controls to miss material misstatements. And detection risk, the chance audit procedures could overlook existing errors. Auditors juggle these factors to ensure their opinion aligns with the financial reality. From assessing complex transactions to evaluating internal controls, each component plays a crucial role in the audit process. Remember, while auditors can manage inherent and control risks, detection risk is the wild card they must directly address. So, next time you review financial statements, consider the intricate dance between these risk components. Ever wonder what goes into planning an audit? Let's dive into the key elements. First, we set the stage with preliminary engagement activities, ensuring independence, and establishing terms. Then, we delve deep into understanding the entity, from industry insights to business risks. Next, we pinpoint materiality levels and identify significant risks that demand special attention. Crafting tailored audit procedures, assembling the right team, and setting a realistic timeline round out our strategic approach. In essence, audit planning is about meticulous preparation, insightful risk assessment, and effective team coordination. What is materiality in audit planning? It's the critical threshold where missing or incorrect data can sway financial decisions. Auditors use it to pinpoint significant errors. Planning materiality is the maximum allowable error for financial statements, often a percentage benchmark. Performance materiality, lower than planning, minimizes the risk of total unchecked errors surpassing planning levels, typically 50 to 75% of planning materiality. Balancing precision and risk, materiality ensures financial accuracy. In Chapter 4, we delve into the essence of professional skepticism. It's not about assuming the worst, but about maintaining a questioning mind, staying vigilant for potential errors or fraud, and critically evaluating audit evidence. Professional skepticism demands verification, not blind acceptance. It's a key mindset for auditors to uphold integrity and accuracy in their work. So, how can we embody this attitude effectively? by being alert, questioning, and never settling for surface-level information. Remember, professional skepticism is the cornerstone of a thorough and trustworthy audit process. Embrace the power of professional skepticism. Question everything, seek independent verification of key matters. Watch for inconsistencies and be alert to conflicting evidence. Challenge assumptions and remain open to new perspectives. Remember, one source is not enough, corroborate with multiple independent sources. Stay vigilant, stay curious, and seek sufficient evidence always. Let your skepticism guide you towards clarity and truth. In the realm of professional skepticism, real-world scenarios often call for a critical eye. When faced with a sudden surge in revenue at year-end, delve into shipping records and payment terms to ensure compliance and avoid deceptive channel stuffing. Similarly, when observing related party transactions, scrutinize high-priced deals with the CEO's family members by seeking independent valuations and verifying transparency. And in cases of management override, closely inspect journal entries reversing accruals, assessing their legitimacy and proper authorization. Vigilance in these scenarios is crucial for upholding integrity and transparency. Remember, in the world of professional skepticism, scrutiny uncovers truth. In the world of auditing, risk assessment serves as the bedrock for effective planning and execution. By truly grasping business and fraud risks, auditors can optimize their strategies for maximum impact. Prioritizing high-risk areas allows audit resources to be channeled efficiently, boosting overall effectiveness. Through meticulous planning driven by risk assessment, audit quality is elevated to new heights. Always maintain a critical eye and a questioning mindset, evaluating audit evidence rigorously throughout the engagement. In essence, success in auditing hinges on embracing risk, planning comprehensively, and upholding professional skepticism. In a high-stakes environment like TechStart Incorporated, identifying risks is crucial. The scenario paints a vivid picture: rapid growth, a CEO with unchecked power, revenue pressures, and questionable accounting practices. Business risks loom large, compounded by potential fraud risks from internal vulnerabilities. The absence of oversight, high turnover in key roles, and suspicious timing of sales transactions all point to red flags. As the company races towards securing venture capital, these risks could spell disaster if left unchecked. Vigilance and proactive risk management are essential for TechStart's sustainability and success. At TechStart, the business risks loom large: operational challenges with staff turnover, financial uncertainties tied to funding, and the strategic tightrope of rapid growth. Delving into fraud risks via the fraud triangle reveals pressure to hit targets, lax controls inviting opportunities, and the slippery slope of rationalization. High-risk accounts beckon scrutiny, especially in revenue recognition, accounts receivable, and overseas deals. When planning audit procedures, think substantive testing of year-end sales, scrutinizing revenue recognition, and assessing the control environment. Applying professional skepticism means questioning sales timing, verifying overseas transactions, and challenging aggressive revenue recognition. In this landscape, vigilance is key. Always question, verify, and challenge assumptions to safeguard against potential pitfalls. Stay vigilant, stay safe.